Big jobs report. Markets head into the job report with high hopes, but also high uncertainty. Among the questions, will job growth remain strong despite an undertow of slowing economic growth and a decline in capital spending and manufacturing? Consensus looks for a strong gain, 187,000, which would reverse the 128 last month, and well above, by the way, the job growth rate needed to keep the unemployment rate low. But indicators have been mixed as we go in. I look at the ISM manufacturing employment component. It has contracted for 4 straight months. On the other hand, tale of two cities here, ISM service component expanding the employment there. Claims were up and then they fell back down. ADP, as Tyler told you, the lowest level since May. In the last 12 months, there have been 3 distinct levels of U.S. job growth. Let's take a look. We had an average a year ago. That was, call it the 209,000 average, well above. And then it dropped back down to the 143 area. And then it ticked back up. So will the real jobs number please stand up? Given that the Fed is on the sidelines in the absence of any signs of inflation, a strong number, probably well received by markets. And it would take a number, I'm going to say well below 150, maybe 125 to really raise concerns the economy is weakening more than already thought, in part, Tyler, because there aren't really workers to hire.
Well, we're going to talk about that right now. As you stay right there, we want to keep the jobs conversation going with someone who's done a lot of hiring and is probably in the market for workers right now, our power player and guest host for the hour. Please welcome Jonathan Tisch, Chairman and CEO of Loews Hotels. Nice to have you back,
Good
Jonathan.
afternoon, guys. Great to be with you.
Nice to have you with us.
Thank you for having me.
So I assume you're hiring in whatever markets you're in.
Very much so.
Are you having a harder time now finding workers than you did before? How hard is it?
That's the right way to look at it. It's a harder time. We hope to be an employer of choice. We try to create a corporate culture that young people today, whether they're graduating from colleges, grad schools, want to come and be part of our team. But it is getting a little bit harder. And remember, the hotel industry and travel in general, we are labor intensive. We need a lot of women and men to supply the kind of service that we as a 4-star company are proud of. And it runs throughout the system, wherever your price point is as a hotel company.
So how much does immigration weigh on your mind in terms of finding a path to receive legal immigrants who can be employed in your businesses?
Well, certainly we only hire legal team members, and we feel that the travel industry is the first step to somebody becoming part of our system. This is their chance at the American dream. And if you look at the people who run our hotels, many of them started as servers. Many of them started as housekeepers, as members of the bell staff. So we think that there is a way to work your way up in our industry, but we need team members.
Steve, you and I were talking about the wide openings in manufacturing jobs at a time when manufacturing is not posting the kind of increase of jobs that other businesses are, that there's this big lag across the nation with open jobs sitting empty.
Yeah, that was it was a fun conversation, in part because I kind of know the numbers in the back of my head. Contessa comes over and I looked up the numbers like, wait a second, 500,000 unfilled manufacturing jobs in the country while you have this decline in manufacturing. I think one area of concern about that, Contessa, is you might have what's called job hoarding going on, which is people are so afraid they can't find the next workers, they may be holding on to workers, but also the idea that there are going to be pockets in the country where manufacturing is still going to remain strong. Even more so than the manufacturing laws, job openings are in Mr. Tisch's sector, 1.2 million unfilled jobs in the service sector, in professional business services. You go over to leisure and hospitality, and it's like 1 million unfilled job openings there. You get to the same place. All of it ends up, this is a sign of the U.S. economy coming up against its speed limit relative to the number of workers that there are to power it forward.
So as you go out into the labor market, you're competing with other hotel companies, I'm sure.
Oh, absolutely. But once again, that goes back to my point. We want people to seek us out. We want them to know about us. We're building a couple new hotels, which we can get into in a moment. And I was in Kansas City and St. Louis yesterday, meeting with our new team members. Neither hotel is open yet. And I was saying, why did you leave the company that you were with, some of the biggest names in lodging?
Yeah.
And they said, because we've heard that Loews has a great reputation. We've heard what you try to do in terms of culture. That's exactly the word I was going to use. And that's trying to make a difference for us, differentiate us from the competition.
So has that competition caused you to raise wages and pay so that you can attract the people you want?
Well, that's also a big issue, is pressure on the bottom line. And if you look at the markets where there are minimum wage requirements now that may come from the voters, when you look at markets that are highly competitive, obviously our wages are market driven. And it is becoming an issue, and we have to think about that as we budget for 2020, for 2021, is where does the wage inflation, if you will, come in?
Let me ask you your outlook for 2020. We have hotel revenue projections, revenue per available room, that's expected to grow at a dismal 1%. I cover casinos. The casino outlook for 2020, in Las Vegas especially, you're seeing occupancy rates of 97, 98%. They're booming. They've got group business and conventions booked through 2020. Why are we seeing this divergence, and what does it say to you about the broader American economy?
Well, the reason you're seeing it in certain markets is now overbuilding, oversupply is starting to jump ahead of demand. And there are key markets, if you look at Nashville, Austin, Houston, Dallas, Los Angeles, New York City, which we can talk about later, supply is continuing to come online at a great pace. The demand might not be there. And you're right about the numbers. The RevPAR number that the industry basically is looking at for next year is between 0.5% and 1%. That's not going to cover our cost increases. And there's a lot of pressure on our bottom line right now.